Have you ever wondered what the right way is to pay yourself as a business owner? Do you just take money out of the business account whenever you need it, or is there a more official way to do it? This is a critical question for any entrepreneur, and the answer isn't as simple as it seems. How you pay yourself depends entirely on your business structure, and getting it wrong can lead to serious tax problems down the line. Today, we're diving into the pros and tax implications of paying yourself as an owner versus as an employee. First, let's talk about the most common scenario, paying yourself as an owner. If you're a sole proprietor, a partner in a partnership, or a single-member LLC, the IRS generally views your business as a pass-through entity. This means the business's profits are your personal income. You don't get a regular paycheck with taxes already withheld. Instead, you pay yourself through what's called an owner's draw. The main pro of an owner's draw is flexibility. You can take money out of your business account as needed, without a rigid schedule. This is great for managing cash flow, especially in the early stages when profits might be unpredictable. However, this flexibility comes with a major catch: taxes. No taxes are taken out of your draw, which means you are personally responsible for paying both income tax and self-employment tax on your business's net profits. This can be a huge shock if you're not prepared. You need to set aside money and make quarterly estimated tax payments to the IRS to avoid penalties. Now, let's look at the other side of the coin, paying yourself as an employee. If your business is structured as an S corporation or a C corporation, the business is a separate legal entity from you, the owner. In this case, the IRS requires you to pay yourself a reasonable salary for the work you do. The big advantage of a salary is the irregular paycheck with taxes already taken out, just like a normal job. It makes budgeting easier and ensures you're on track with your tax obligations. For S corporations, there's also a significant tax benefit. While your salary is subject to payroll taxes, the Social Security and Medicare taxes that are split between the employee and employer, any additional profits you take as a distribution are generally not. This can lead to a lower overall tax burden compared to a sole proprietorship. However, a salary isn't as flexible as an owner's draw. It requires a formal payroll system, and the IRS mandates that the salary be reasonable for your industry, which means you can't pay yourself a tiny salary just to avoid taxes. So, which is right for you? It really boils down to your business structure and your personal preference for financial management. An owner's draw offers flexibility but demands a disciplined approach to saving and paying taxes. A salary provides stability and can offer tax advantages, but it requires a more formal and rigid process. The key takeaway is that you can't afford to ignore this. Whether you're taking a draw or a salary, understanding the tax implications is crucial for the financial health of both you and your business. With that said, thanks for watching, and until next time.